so we are going over 11.2 notes. We're going to do sales returns and allowances. So we're going to talk about some contra accounts. We talked about credit memorandums and debt. We talked about when you have these memorandums, a lot of times we're in the general journal, right? Transactions in the general journal. If you get a debit memorandum, you're going to do one thing. If you get a credit memorandum, you're going to do another. What we're going to be dealing with is when we're purchasing, like when we bought supplies on account, that will be a memorandum that you will put into the general journal because it doesn't affect merchandise. So it's not purchases. It's not a sale. So it's not sales, and you're not paying or receiving cash. So you need to be able to do that in the general journal. And so now we're going to continue to do different transactions that will end up appearing in the general journal. And one of them will be this credit memorandum. And when we have a credit memorandum, when I think and hear credit memorandum, I think you're going to credit accounts receivable in the company. So before we had debit memorandums, right? In 11.1, where we debited accounts payable in the company. So now we're working with accounts receivable, and we're going to do the same concept just with the credit and accounts receivable. So what exactly is all this? So let's talk about what's resales. We'll just do this first part. Sales returns, allowances. What are these things? And maybe I can zoom a smidge. Okay. All right. Most merchandise businesses expect to have some merchandise return. We maybe mentioned that. You go to Target, you go to Kohl's, you go to whatever, just a regular store. They usually have a customer service area, and they usually return things, right? And there's a variety of reasons why. Size, color, items, too many, didn't want it, whatever. So this is just a cost of business. You got to have a system in place for people to return items. Credit allowed to customers for sale price of returned merchandise, resulting in decrease in accounts receivable, is called sales returns. Okay. In other words, if you make a sale on account, right, what we do is we would debit accounts receivable. Let's say we made $1,000 sale, right? We credit sales, debit accounts receivable. Well, and what they're saying here, credit allowed to customer sales price returns resulting in a decrease, is they're going to return things. So the bill for, let's say, bond account receivable, your company, if you return $300 worth of items, you're going to owe us $1,000. You owe us $700, right? So they have to have a credit memorandum in place to take this off the customer's bill. So before in 11.1, we were doing it. We were taking the stuff back. So we were lowering our payable by debiting it. Well, now customers are taking things back. They're lowering their accounts receivable. We have to give them a credit memorandum to lower their bill. So that's what that means, decreasing accounts receivable. A credit allowed to a customer for part of the sales price that is not returned. So this is very similar to purchases allowances. So if you did a purchases return, you returned everything. A purchase allowance might be, hey, it's kind of damaged, or I'm only going to pay partially because it's not the right, and they say, yeah. So that's what it is. But the net result is the same. It results in a decreased accounts receivable. They're not going to pay as much. We're going to combine these two accounts just like we did in 11.1. So 11.1, when we have a purchases, returns, and allowance, that's all one account. If it's damaged, if you return it all, parts, pay a little bit less, whatever the case may be. We are doing the same for our customers. but we call this sales returns and allowance. And so what you need is you need to fill out a credit memorandum. And that's what I was getting at. And when I think credit memorandum, you know, you're dealing with accounts receivable, you're lowering it. You just immediately go, I'm crediting accounts receivable. They're returning something. They owed us this much. They're returning it. We got to lower their bill. So the credit memorandum is this up here. It's just this form that shows the item that is being returned, the price of the item, when it was, what it is, all that. Okay. A form prepared by the vendor showing the amount deducted for returns. Okay. Everything that'll be on there is what is needed: address, you know, quantity, price, when it happened, who the customer is, if they got, you know, account numbers, all those good things. So sales returns and allowances is going to be considered a contra account to sales. Okay. So when we think of sales, hopefully you think of sales in this way. Sales is increases with the credit. So sales returns and allowances is going to be a contra account to sales. And so that's why you see the debit. Sales normal balances are credit. Sales returns and allowances will be a debit. Okay. That's what that is showing you. So when we get a credit memorandum, you know you're dealing with the sales returns and allowance, and we're going to have to be able to journalize this transaction. Okay. It says on November 9th, 3 Greener companies sold merchandise to Lake Automotive. They returned it on the 16th. The sales reduces the amount by $69, da, 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 da. They returned $65 worth of it. They had some tax. Okay. Because the transaction is not a cash receipt, we're not receiving cash. It's not going to be in the cash receipts journal. Okay. It's not a sale on account. We're returning things. Okay. So, and we want to keep track of all the stuff that is being returned. Who's returning it? How much is being returned? Is it a certain department? Do we have salespeople that are giving people the wrong information? You know, so you keep track of this in this sales returns and allowances account. Okay. So in our transaction, it says December, I can't show both, but granted credit to Lake Automotive for merchandise returned $65.85 plus tax $395. From sales slip 500 for a total of $69.80. Credit memorandum. All right, that's right. So you can kind of think, all right, we got this merchandise being returned. It says credit memorandum. We got to return the sales tax, record that as well, because we don't want to pay the government $3.95 because we didn't make that sale. That sale no longer exists. They're returning that goods. So we need to lower our payable. We need to then, we don't lower sales because we did make the sale. We want to keep track of how much is being returned. So we debit the contra account to sales, sales returns and allowances for the sale. We debit sales tax payable to lower sales tax payable. And the credit memorandum signifies accounts receivables getting smaller and the company. So we have the backslash. So like last time we had debit memorandums, we had accounts payable and the vendor in the debit. When we have a credit memorandum, we have accounts receivable and our customer. Okay. That's always been the easiest way. It might not make much sense to you, but that's always how we've always kind of done it. So the debits have to equal the credits. Okay, and you can see that with our T accounts. Sales returns, sales tax payable is decreased because we don't want to pay the government that. And we move on. They got all the steps there. So that's one transaction. Hopefully we'll have the credit memorandum where we credit accounts receivable and the customer. Posting, we're not going to spend a lot of time. We kind of know how to post. We've been doing a lot of it. You know, just make sure you put the vendor or the customer name number on the bottom. We'll put accounts receivable on top. They're showing you obviously how to post to the subsidiary ledger, the accounts receivable. These entries in the general journal may affect account balances in both general ledger and subsidiary accounts. True or false? True. A transaction in general journal will affect both. Yes, it can. Okay. It'll affect accounts receivable, which is a general ledger account, and the customer. This one would be Lake Automotive. And then the first one, a general journal account can affect accounts payable, which is a general ledger account, and the vendor. Okay. So they're just walking through this. We're not going to walk through all the steps. Just make sure that you understand the post-reference part here. Debits to debits, subtract credits from debits to get updated balances of what these people owe us. So this, they used to owe us 606, now they owe us 536. Are you guys kind of okay? I'm not rushing through the posting. You guys are all right with that? Hopefully you understand what this is all about. We're trying to make sure everybody knows how much money they owe us. Okay. We can skip that part. And now we have one entry called correcting. So we'll do the credit memorandum on a return. We'll post it. And then there's also a correcting entry. So what is a correcting entry? Okay. Errors can be made in recording a variety of different things. They talk about subsidiary ledgers, general ledgers. So for example, they have one on December 26th. They found a sale on account to Skinner College that was incorrectly charged to Wells Apartments. Okay, they found that a sale on account was incorrectly charged. All right. So what we're basically saying is Skinner College was incorrectly charged, or the sale on account to them was incorrectly charged to Wells. So what we need to do is make sure Skinner College actually gets charged. And then we have to do whatever we did to Wells, we got to do the opposite. So if Wells is our account receivable, and if we put $500 in here that wasn't supposed to be, and it was supposed to actually be in Skinner. So if this is Skinner, and we don't have anything here, right? We got to get rid of this $500 to get these guys back. So we're going to have to credit it, and then we're going to have to debit Skinner to get it back to normal. Because this is sales accounts receivables. Okay, that'll be what we'll have to do. They talk about how a diagonal line is not needed to this because the accounts receivable doesn't change, or the accounts payable doesn't change. Just depends what one you're dealing with. So the idea is it was supposed to go into Skinner, but it went into Wells. So we got to get rid of it. So you can see that this $334 went into Wells on the 22nd. You can see it on the ledger. You got to get rid of that. So you got to credit it and you got to debit the correct account. So when we make a correcting entry, you want to correct it by, if it's an accounts receivable account like this, you need to debit who is correctly supposed to be debited that you didn't, and you want to credit the people that you did debit because you want to get it off their bill. In this case, otherwise we'd be charging Wells Apartments for a thing that they didn't pay for, a service they didn't get, or a product or merchandise they didn't receive. So we got to correct it quick and update their balance. And then you debit the correct account. Okay, so you'll debit Skinner, credit Wells, and that is all she wrote. And they got the steps right there. Just a correcting entry. So we have two entries we got to go over. A credit memorandum for customers that are returning merchandise, and a correcting entry when we accidentally charge the wrong vendor, the wrong customer or something. We got to correct it quick.